Hello everyone. My name is Hansani Veerasinghe, the engagement partner for this audit of Southern Laundrette Private Limited. Before we begin, I'd like to introduce our audit team. We have formed a professional team to conduct this audit for Southern Laundrette Private Limited, ensuring that every part of the audit process is handled efficiently and effectively. So, I am responsible for leading the entire audit engagement and ensuring compliance with audit standards. Supporting me is our Deputy Manager, Ms. Shiny, who assists in planning and reviewing the audit process. Our team also includes two supervisors, Ms. Lianage and Mr. Varun, who oversee the key financial areas of the entire audit. We have four audit associates, Ms. Sharindi, Ms. Bandara, Ms. Shashinika and Mr. Anushka, who handle the detailed audit work. Finally, our team is supported by two trainee auditors, Ms. Herat and Ms. Senanayaka, who assist with fieldwork and documentation. Together, we aim to deliver a high-quality audit that meets all professional and regulatory requirements. Now, let me give you a brief overview of the company we are auditing, which is Southern Laundrette Private Limited. It's a private limited liability company incorporated on 19th November 2015 under the Companies Act number 7 of 2007. The company provides laundry and garment care services, including wash and dry, ironing, curtain cleaning, and offers pick-up and delivery services in areas like Tangol, Dikwella, Irikatia, and Thalalla, Rakava, and Ranna. It mainly serves hotel and corporate clients, making it an essential support service provider in the tourism and hospitality industry. The company operates with a small to medium workforce, about 1 to 50 employees, and our audit covers the period from April 1st, 2023 to March 31st, 2024. The registered office of the company is located in Polwatta, and the company is managed by Mr. Mallava and the company secretary is Mrs. Kumari.
Let's begin with the purpose of the audit plan. An audit plan is a very important step in conducting an audit. It helps us organize our work properly and make sure we focus on the most important risk areas. One of the key reasons is risk mitigation. We want to make sure we identify any risk in the financial statement that might contain errors or misstatements, especially those that could have a big impact. Another important reason is efficiency. When we plan properly, we focus our time, resources on the high-risk areas rather than spending unnecessary effort on low risk. It helps us both effective and time efficient. Planning also ensure compliance. As auditors, we have to check whether the financial statement follows all required standards and legal guidelines. Now, let's discuss. These are the deliverables timeline for the audit plan, which outline the key stage over 5 weeks. In week 1, we begin with the engagement letter, which is the formal agreement between the client and the auditor. Along with that, we also conduct audit planning. This all involves identifying key risks and designing suitable procedures. Moving to week 2, we start preparing audit working papers. This is where we document all evidence, procedures, and findings related to the audit process. In week 3, we obtain the letter of representation from management. This letter confirms that the management acknowledged their responsibility and provide assurance over the accuracy of the information shared. Then in week 4, the audit findings are reviewed at the supervisory review stage, where the audit supervisor check for accuracy and completeness. Finally, in week 5, we deliver the final audit report, which include all the key findings and conclusions of our audit engagement. The timeline ensures that the audit conducted in a structured and efficient manner, covering all the associated deliverables.
Here we have categorized the major audit risks into three main areas: financial risk, operational risk, and compliance risk. Each area highlights specific risks that could have a significant impact on the financial statement. Let's talk about uh, financial risk. These are risks that directly impact the financial reporting and overall financial health of the company. First one is revenue recognition. There is a risk of revenue being recorded prematurely or fraudulently to inflate the financial result. As per ISA 240, revenue recognition is considered a significant risk due to its capability to manipulation. Second one is inventory management. Improper evaluation or recording of inventory can lead to misstated financial statements. This included overstatement of inventory or errors in stock reconciliation. Finally, non-current asset. Risk of incorrect valuation or depreciation, especially in compliance with LKAS 16, misstatement may occur due to incorrect useful lives, impairment, or incomplete asset registers. Let's move on to operational risks. These risks arise from the company's internal process and cost handling. One key concern is the risk of material misstatement in direct costs. Direct costs have shown a significant increase if not accurately allocated or recorded. This could lead to overstated or understated expenses, ultimately impacting profitability and decision making. Finally, compliance risk. These relate to the company adherence to relevant law, regulation, and accounting standard. One key area of focus is adherence to LKAS 16, which governs the accounting treatment of non-current assets. The company must ensure proper valuation and depreciation of these assets to maintain accuracy in financial reporting. Failure to comply with these standards could lead to financial misstatements and potential regulatory consequences. That's why strict adherence to accounting guidelines is essential to avoid compliance risk.
Now, let's move on to the risk assessment related to the statement of comprehensive income. First, let's talk about revenue recognition, which falls under ISA 214, the auditor's responsibilities related to the fraud. We notice that revenue has grown significantly by 137.1%. While this might look positive on the surface, such a sharp increase could also be a red flag. It could indicate a risk of revenue manipulation of misstatement, possibly done to present more favorable results to stakeholders. Since ISA 214 considers revenue recognition a perceived fraud risk, this area requires special attention during the audit. Next, we identified a risk related to direct cost. Interestingly, direct costs have increased by 149%, which is even higher than the revenue growth. This could point to several potential issues, such as incorrect cost allocation, unsupported or unrecorded expenses, or even errors in inventory valuation. These factors could result in the understatement of the cost of sales or the misclassification of expenses, ultimately affecting the accuracy of gross profit reporting. So this is two risk area to concern that need to be truly examined during the audit process. In summary, both revenue and direct cost figures require careful inspection to ensure that there are no material misstatements or instances of fraud. Moving on to the risk assessment based on the statement of financial position. First, let's look at the non-current asset, which is property, plant and equipment. There has been a significant increase in this category, rising from approximately 919,287 in 2023 to 3,787,873 in 2024. Such a substantial change raises concerns regarding the potential misstatements. This could be due to incorrect asset valuation, errors in depreciation calculations, or even failure to disclose asset disposals. As auditors, we need to carefully assess whether these additionals are properly supported and accounted for by relevant accounting standards. Next, we turn to inventories. Inventory has increased sharply from 42,614 in 2023 to 196,603 in 2024. This raises a red flag for possible overstatement of inventory balances. There may also be valuation issues. If the company is holding obsolete or slowly moving stock that has not been properly adjusted in books, we need to assess whether inventories have been valued at the lower of cost or net realizable value, as required by accounting standards, and ensure accurate classification and disclosure. In summary, both property, plant and equipment and inventory required detailed audit procedures to ensure their accuracy, valuation and proper presentation in the financials.
I will be present in the internal control review of Southern Laundry. This review ensures that the company's financial and operational processes are secure and well managed. First, let's go over key internal control areas. Authorizations and approval. Managerial approval is required for significant transactions. Reconciliation. Regular reconciliations of cost accounts with inventory records ensure accuracy. Physical control. Inventory is safeguarded through physical counts. Valuation review. Proper valuations and depreciation policies as per LKAS 16 are followed. Segregation of duties. No single person should control all aspects of a transaction to prevent fraud. Now, looking at control types and observations. Preventive controls ensure risks are minimized by verifying staff background checks and requiring managerial approval for large orders. Detective controls involve regular monitoring such as monthly cash record assessment and random inventory checks. Corrective controls help resolve errors like fixing billing issues flagged during reconciliations and updating policies to prevent recurring risks. By implementing these controls effectively, we enhance financial integrity, reduce risk, and ensure smooth operations at Southern Laundry.
Next, we'll discuss the audit procedures for revenue recognition under SLA US 240. Revenue recognition is a critical area in auditing because companies may manipulate revenue to show better financial performance. To ensure that revenue is fairly stated, we apply key audit assertions and procedures. First, we have occurrence. This ensures that the revenue recorded actually took place. We perform vouching by selecting sample of recorded revenue transactions and matching them to delivery notes or customer confirmations. Next, completeness. This checks whether all revenue transactions that occurred have been recorded. We do this by tracking delivery notes and sales orders to sales invoices and verifying them against the general ledger to confirm that all sales are properly accounted for. Then, accuracy. It is essential to ensure that the recorded revenue amounts are correct. For this, we perform recalculations to verify that the sales amounts in the financial statements match the amount actually invoiced to customers. Another important assertion is cutoff. Revenue should be recorded in the correct accounting period. We conduct cutoff testing by inspecting year-end transactions to ensure that revenue is recognized in the appropriate financial year. Finally, we assess classification. Revenue should be properly classified in the financial statements. We review journal entries to identify any unusual or inappropriate classifications that could mislead users of financial statements. By applying these procedures, we can ensure that revenue is recorded accurately and in compliance with accounting standards.
Now let's move on to the audit procedures related to the material misstatement in direct cost under SLAUS 315. Direct costs are crucial in financial reporting and any misstatement can significantly impact the accuracy of financial statement. To ensure correctness, we apply key audit assumptions and procedures. First, let's take about occurrence. We need to confirm that the record direct costs actually accrued. To this, we review supporting documents such as purchase invoice, purchase order, and good review notes to verify authenticity. Next, completeness. We must ensure that all direct costs included have been recorded. We perform cut-off testing to verify the purchasing invoice recorded near the year end are included in the correct period. Then we have accuracy. These assumptions ensure that costs are recorded correctly. We perform recalculate by checking a sample of purchase invoice to verify that the amount and unit cost are actually recorded. Move on cutoff. We need to ensure that costs are recognized in the right accounting period. We conduct invoice testing by the review transaction recorded just before and after year end to ensure proper period recognition. Finally, classification. All direct costs should be recorded in the correct category. We review journal entry to confirm that the direct costs are appropriately classified and not mistakenly include under operation or administration expenses. By performing these audit procedures, we can ensure that direct costs are actually reported, minimization the risk of material misstatement.
Let's discuss the audit procedure related non-current assets under the LKS 16. Non-current assets, such as property, plants, and equipment, represent significant investment and investment for the company. Therefore, it is critical to verify the accuracy through key audit assessment in the procedures. First, let's consider occurrence. We need to confirm that the record assets genuinely excite and belong the company. To do this, we review supporting documents like purchase invoice and ownership titles. Next, we focus in valuation. This ensures that assets are recorded at the correct value. We verify the company has applied appropriate description method and usual living according to the accounting policy. Next, moving on the completeness. It is important to ensure that all assets accurate and recorded. We do this by matching purchase record with the fixed asset register, confirm that no assets are omitted. Finally, we examine presentation. This involves reviewing disclosures related to depreciation and revaluation to ensure compliance with relevant accounting standard. By applying these audit procedures, we can ensure that non-current assets are accurately reported, minimizing the risk of financial misstatement. Thank you.
Let's continue with the audit procedures related to inventories under case 2. Inventory is a key component of a financial statements and its accuracy is essential for reliable reporting. To ensure this, auditors perform several procedures based on key assertions. First, under occurrence, we conduct a physical count of inventory and compare it with the inventory records to confirm that inventory actually exists. Next, for valuation, we review the costing method used FIFO and weighted average and ensure it is consistently applied in line with accounting policies. Moving on to the completeness, we compare purchase and sales record with the inventory records to verify that all inventory items are recorded and nothing is omitted. Under cutoff, we test inventory movement near the year end to ensure they are recorded in the correct accounting period, preventing misstatement in financial reporting. Finally, in presentation, we confirm that inventories are correctly classified and disclosed in the financial statement in compliance with relevant accounting standards.
Finally, let's discuss the relevance of audit procedures to practitioners and how they contribute to improving audit quality. First and foremost, a well-structured audit plan ensures a thorough and effective audit process. By conducting focused risk assessment and tailoring audit procedures to specific areas, auditors enhance the accuracy and reliability of financial reporting. Another critical aspect is fraud detection and prevention. Effective internal controls help mitigate the risks and fraud by ensuring proper checks and balances. Additionally, early detection mechanisms allow business and identify and address financial misstatements before they escalate. Audit procedures also play a key role in client assurance. Reliable and accurate financial statements build trust and confidence among stakeholders, reinforcing the credibility of the company's financial reporting. Lastly, audit ensures compliance with auditing standards and regulatory requirements. This reduces the risk of penalties and legal issues that may arise due to non-compliance, ultimately safeguards the organization's reputation. In summary, improving audit quality not strengthens financial integrity but also enhances stakeholders' confidence and regulatory compliance, making it a crucial aspect of the audit profession.